Hey, welcome back everyone. It is time to talk about Chevron again. If you remember, I took on a poor man's cover call trade with Chevron back when it was trading at 144. I thought at 144 it was testing a line of resistance that we could pretty much bank on. Well, since then it's fallen down near 135 and it's popped up to 139. I still like it here around 139. I even like it at 144. Today we're going to talk about a poor man's cover call trade and why we're doing it now. Now look, I don't call for anyone to buy shares at any particular point. What I try to do and share on this channel is what I see, seeing the world through my eyes. And what I see is this: Chevron absolutely is trading in a range that we can bank on, and that's between 139 and 150. So with them paying their dividend and earnings not for a couple months, this really opens up the window for us to get involved with a poor man's covered call trade. So with it trading at 139x, we're getting in a more favorable position where the stock can recover and move higher. I do want to show you something here because it actually is bouncing off the bottom there. You can see it after it falls below 144 where I got involved. And I'm going to show you my poor man's cover call tracker. I got involved when the stock was trading at 144. I then got involved when it was trading at 141. Now with it falling again, I'm going to add to that position. We're going to talk about my poor man's cover call trade, so stick with me because I purposely left money back just in case this were to happen. Because when it did break past 145, which I thought was near-term support, I thought, why take 10 contracts? Let's do 3, let's do 2. And what we want to do is kind of feather into this trade. Well, with its recent price action and the market shifting, the market shifted out of the high-tech stocks and they got involved in all kind of different stocks like pharmaceuticals, energy, so on and so forth. Well, when that shift happened, they decided to get back in to the high volatile stocks because they had sold off considerably. So guess what? They sell off Chevron. Now they sold it off, like I said, to that 139 number, and you can see we're getting a little bit of a bounce and we get a bunch of selling where the market was sold off. And then of course, as they're buying the high techs up again, Chevron does not get picked to enjoy any of that rally. So it's trading at 139x. Let's go ahead and take a look real quick at this support line before we get to the poor man's cover call trade. You could see since January 2024, and you can even go back to December 2023, that 44-ish was the line of support. Now, it broke that considerably, and now the question is, where is that next line of support? It could be 135 before it makes that move higher. We'll have to see. Back here, you could see that it tested in and around 141 with that intraday dip. It did not retest that. It turned around and went higher. Even though this hits 135, that does not mean it's going to retest that. And notice back here, when it tests 140, it did not test it there. With that said, where's your support? Because if you go all the way back, you might be looking at 2 years worth of support. So what they're going to do is they're going to say, well, let's draw a line just like this. And of course, then they're going to draw this line. So once it gets around 135, you might get to 140. So how do we play this? I'm going to use the poor man's covered call. What we're going to do is this. We're going to pick that 96 delta leap. I don't know if you could see that, but the 96 delta leap gives us that 96% run. If the stock were to move $1, my leaps call option, for which I bought the 105, paid $40 for the first set and 37x for the second. It's a 96 delta leap. So if the stock were to recover every single dollar it moves, my leaps call option will move 96% of that move. And that is perfect because when the stock moves higher, and I buy back the near-term covered call, which I'll probably have on, I'll then sell my Leaps call option, and what will probably happen is we will collect most of that profit. Now, you say to yourself, what do you mean by that? Well, when we write a covered call, a near-term covered call, and let's say Chevron breaks through the strike price, and say that strike price happens to be 140, okay? Strike price 140, stock pops through it. If I have to buy the option back when it's trading at 143, well, I'm going to have to pay $3 in intrinsic value or in real money. And that is real money. $3 plus time value to buy this current near-term cover call option back. Okay? So that's $3 full. Well, the Leaps call option that is going to support that buyback is only a 96 delta leap, which means if this thing moves $3 above the strike, then you could just do some simple math and say that my Leaps call option is going to move about $2.90 of that. So I'm losing 10 cents in real money when I buy back the $3 of intrinsic value. Well, my Leaps call option is making me $2.90. That 10 cents gets made up in the current covered call that I'm closing and all of the other covered calls that I've written. So this is why it's important to try to use that 95 to 96 delta leap, because had this been a 75 delta leap, which some on YouTube will tell you to use the 75 delta all the time. Well, that's okay, as long as you understand that you want to write deep out of the money strikes, because if this stock were to punch through and jump $10 above my strike, that's beautiful, beautiful move. I'm going to have to buy back the near-term cover call, pay the $10, and then sell the Leaps call option to make up for that. Well, because I used the 75 delta leap, the stock moved $10 and I paid that back, but my Leaps call option only moved $7.50 of that. That difference right there gets taken out of all the covered calls you've written. This is why we try to use that deep in the money strike, that 95 to 96 delta. Over the years, I've used 75 and 80 delta leap, but what I'll tell you is I don't write tight to the money covered calls in that situation. I use the expected stock move calculator, which is a part of the downloadable, brand new Poor Man's Cover Call Tracker. It's in the description and it's in the comments. If you download your tracker, you'll have this one where you'll have all these calculators, and you have a chance to pick up a free 1-month offer to my membership. No questions asked, no nothing. If you want to get your Poor Man's Cover Call Tracker, you have a chance to get your 1 free month of my upgraded CPT Dashboard, the membership for which people love to follow my trades. And to be honest with you, they got all these trades and they knew exactly when I did this trade and why. Just in summary, talking about Chevron, I thought it was a great buy at 144. It falls to 141. We're not sweating it. We actually went ahead, saved a little bit of money. We decided to add to the trade. So at 144, I went ahead and bought that Leaps call option. Then when it fell to 141, I bought 2 more Leaps call options. And now with the stock trading at 139, I might wake up tomorrow and add another 2 Leaps call options. Because notice I have no current covered call. This is going to reduce my cost basis on my Leaps call options, allowing me to break even sooner. And right now, I'll tell you what, if I can get out of this trade in and around 145, which I think we can, this is going to be potentially a 25% trade. And if I pick up a couple more Leaps call options, which will be a little bit cheaper, you could see the last one I paid 37 for, and I think it's currently trading for 35. We can pick that up, reducing our break even. We might be able to be out of this trade in the next 30 days, making a very handsome profit. Now, before I let you go, if you do download your very own copy of the Poor Man's Cover Call Tracker and have a chance to get your 1 free month offer, you need to use the initial trade setup. You have to. Every single poor man's covered call trade needs to start with the poor man's covered call initial trade setup. If you're not doing that, you're breaking golden rule number 1 when we use the poor man's covered call. What we need to do is make sure that our time value is not that expensive. And you could see this is an amazing trade that I did originally. It's even better now, but check this out. When I placed this trade, the time value cost was, this is actually funny. We're using Chevron, and we're using Chevron to collect some great premium. My time value cost was a mere 43 cents. I paid the cover call writer, because remember, I am buying the right but not the obligation to take his shares at 105. I paid $40.27. I bought 3 contracts. I paid him 43 cents to be able to use his shares for the poor man's cover call trades that I'm doing. That equals 0.3%. Not 3%, 0.3%. So my very first cover call pays for it. Now it's gravy. Now we're just trying to hope that Chevron trades back above 144 and we can get out of the trade clean, making all that profit. But here's the deal. You have to use the initial trade setup because you have to see how much you're paying in time value premium. That is the key. This is where you will get stuck, you will get ripped. Could you imagine if that was $4 and the stock starts to fall and all that time value comes out of your Leaps call option? A Leaps call option for which this entire trade is set up where it's trading for $40. This stock takes a hella fall. Next thing you know, it's trading for $36, and you are not going to be profitable unless you write covered calls that make up for that $4 loss. See, that's why you need to make sure your initial trade setup has you paying less time value. That's the important thing here. So, you know why I like Chevron? I think it broke support, and I think anywhere around 139 is a great opportunity to get involved. And if you're going to get involved, then what I need you to do is use the initial trade setup. Make sure you're buying a Leaps call option that is 95 delta or above, and that time value premium is in and around 0.3 or 0.4 because that is the true cost of the trade. I paid $40 for the right to buy this guy's shares at 105, for which I won't. I'm just using this option so I can write near-term cover calls. But here's the deal. I only paid him 43 cents to do that per share. That is nothing. We made that on the very first trade. So what is the true cost of the trade? Not the 40 bucks. Do the math. Do 105 plus the 40.27. And you can see when the stock's trading at 144.84, I'm paying about 43 extra in premium. Because ultimately that's what I'm doing. I'm paying him $40.27 to essentially have the right to take his shares at 105. Add these two together and you'll see what you're actually paying him. The initial trade setup calculator does that for you. Tell me what you think about in the comments below. Is the poor man's covered call a trade that you do, you want to learn more about, or you just stay away? See, I've done so many poor man cover call trades this year. We do this on all the big S&P type stocks, largely because I don't have to use that much capital. And they're great because they trade in trading ranges. Merck was a perfect example of that. Picked the perfect entry, and I believe they took my Merck shares, one trade in, made something like 15%. The poor man's covered call is a great way to get involved, use less capital, and generate cash on cash percentage gains that are much bigger had I laid out all the capital needed to buy Chevron at 144. If you want to follow any of my poor man's covered call trades, all you have to do is sign up for my membership. Go to cptdashboard.com, click Upgraded Dashboard, and get your 1 free month offer. You can follow all of my poor man cover call trades because you see them when I do them. Here is my most recent on yen. We went ahead and bought a Leaps call option on yen, and we wrote a covered call. See, I love finding great opportunities to get involved. And I'll either buy the shares, I'll write a covered call, I'll do a put, or I'll buy Leaps call options, spending less money up front, but making all that monthly covered call premium. If you want to follow my trades, CPTDashboard.com, click Upgraded Dashboard, get your 1 free month offer. I'm actually going to do another Merck Poor Man's Covered Call because it's trading right where I did my last Poor Man's Covered Call, which wasn't but 2 weeks ago. It is absolute money in the bank. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.